You got hit with a big tax bill in April, and you're obviously not happy about it. Here are some of the reasons why you may have owed money on your taxes and what you can do to prevent that for next year. Now, before we get started, if you find this video valuable, please hit that like button and don't forget to subscribe so you don't miss out on any future educational videos. Let's get into it. The first reason why you may have owed money on your taxes this past year is because you underwithheld on your W-2. If you work for an employer as an hourly employee or a salaried employee, you will get a W-2, which is the IRS tax form that shows how much you've gotten paid and how much money in taxes has come out. And for W-2 employees, those taxes come out automatically. So things like Social Security and Medicare will be deducted automatically from each paycheck. You should also see other taxes being withheld as well. If you owed money on your taxes and are a W-2 employee, it most likely means that you did not withhold enough or any money for taxes throughout the year and from every paycheck. So essentially, you didn't pay your taxes in every paycheck, and at the end of the year in April when taxes are due, that bill for you came due. To get this fixed, you need to reach out to your HR department and increase your withholdings. Yes, this does mean that you will be seeing less money in every paycheck, but it does mean that you are paying your taxes and you shouldn't have that big tax bill, if any, come due in April. The second reason why you may have owed money on your taxes this past April is that you are a 1099 employee and did not pay any taxes at all. For some of us, we are not W-2 employees. We are not considered employees by that company. We are considered what is called contractors or freelancers, and because of that, we will get what's called a 1099. This document shows the income that we've received throughout the year for the work that we've done. Now, unlike a W-2 where Social Security, Medicare, and other taxes may be withheld, your 1099 is just going to show the gross amount, and you as the worker get paid out that gross amount as well with zero withholding. So no money being withheld for taxes, no money being withheld for things like Social Security and Medicare. And here's an important point to note. When you are a W-2 employee, you split the Medicare tax and the Social Security tax with your employer. You pay 50%, they pay 50%. But as a 1099 worker, you are responsible for paying 100% of those taxes on your own. So because you receive a 1099 and you have none of those taxes withheld, Social Security, Medicare, the other taxes, you are responsible for keeping that money aside and making sure that you have the money available to pay your tax obligation. Now, for some people, they wait until the last possible minute. They will wait until April to pay their taxes, and it's okay for them because they have planned ahead. They know they have the money aside to pay those taxes. They've done the calculation and they have an estimated amount of what they think they'll owe, and they keep that money aside. And once their taxes have been figured out, they send that money to the IRS, no problem. And again, that's fine if you've planned for it, if you set money aside and you want to pay that way. But if you don't have that money set aside, you're going to run into some issues when that tax bill comes due. This means that in receiving your 1099 income, you yourself have to set aside money for taxes. You have to account for that and make sure that you can meet those obligations when they come due. So a suggestion that I give my clients is to look into paying your taxes on a quarterly basis. And you can do this through the IRS's federal website and also your state website. Paying quarterly estimated taxes in this way spreads out your tax burden throughout the year and prevents you from having that lump sum tax obligation come due in April. The third reason why you may have owed money in your taxes this past year is that you had equity compensation that vested. If you earned equity compensation like restricted stock units or RSUs, they are taxed as ordinary income and become taxable upon them vesting, which means that they become 100% yours. Now, vesting is not actually selling the security and selling the units, but it's just taking 100% ownership of that. In the eyes of the IRS, that is a taxable event, and you are responsible for paying taxes on that vested amount. And again, this is all before you may actually decide to sell your shares. You've just received 100% ownership of them. So there are a few options to dealing with restricted stock units and equity compensation that's vested. Here's the most common method, and that is what's called net exercise. This essentially means that you instruct your employer to withhold a certain amount of units to cover your tax liability and bill. Once that has been settled, the remaining units will then be given to you because your tax obligation has now been paid. There are other options for dealing with equity compensation, and I recommend reaching out to your financial advisor and financial professional to figure out which method is best for you. The fourth reason why you may have owed money in taxes this year is that your cash earned interest. If you have excess cash parked in a high yield savings account, it's earning interest, and that interest is taxable under the IRS rules. That interest is taxed at ordinary income rates, and your high yield savings account provider, whatever company that is, will send you those tax documents detailing the interest that you've earned throughout the year. So how do you avoid paying taxes on that? You don't. The cash that you have in these accounts is earning interest, it's growing, and that is most likely the reason why you've put your money into these accounts, to generate interest, to grow your money and have it earn more money on itself. If you don't want to pay taxes on that money, then move your money out of a high yield savings account, forego the high interest that you may be earning, and stick it in a standard traditional bank account earning less than 0.5%. My guess is, though, that's not what you want your money to be doing. And to me, this is a small price to pay to have your money in a safe account earning interest. The taxes in this case are not a big deal. And the last reason why you may have owed money on your taxes this year is you had unexpected capital gains and distributions from your after-tax accounts. If you have your money in after-tax accounts, like a brokerage account, you may have taxable events that occur during the year. For example, some securities pay a dividend, and under the IRS rules, that is treated as income and taxed as such. Now, this includes dividends that have been paid out to you and dividends that have been reinvested to buy more stock or more securities. Now, some securities, like mutual funds that pool their assets together and invest in different securities, can have internal trading activity that may cause things like capital gains distributions. And within those mutual funds, they may have securities that also pay out dividends as well. Again, the dividends will be taxed as income, but the capital gains distributions will also be taxed as well. So within the fund, if they chose to sell from one security to another, you will be on the hook for those capital gains distributions and for paying those taxes. So, are you invested in tax efficient securities? Do you know which securities are tax efficient and how you can benefit from them? If you don't, this would be a good time to reevaluate what you own in your brokerage account. There's also another common reason why people may see taxable events in their brokerage account, and that's because of trading activity. The buying and selling of securities becomes a taxable event and will be recorded and sent to the IRS for tax purposes. So if you sell a security that you've held for less than a year, it will be considered a short-term gain and taxed at ordinary income rates, which can be as high as 37%. If you trade securities that you've held onto for more than a year, those gains are now long-term capital gains and will be taxed at those more favorable long-term capital gains rates, the highest of which is 20%. So, did you make a lot of trading moves within these accounts? Were they short-term trading moves with securities that you owned for less than a year? Were they longer-term trading moves for securities that you owned for longer than a year? And how did those trades affect you tax-wise? You need to know how you're invested within these accounts, and you need to understand what the tax implications are of the investments and of your moves within the account. So we went over 5 reasons why you may have owed money in your taxes this year. Number 1 is that you underwithheld all year long on your W-2. Number 2 is that you paid little to no taxes on your 1099 income. Number 3 is that you have equity compensation that vested. Number 4 is that you earned interest on your cash in things like a high yield savings account. And number 5 is that you had unexpected capital gains and distributions in your investments in your after-tax accounts. If any of these sound like your situation, it's time to revisit your finances, it's time to revisit your income, your investments, and figure out how to be more tax efficient going forward. Understand your withholding on your W-2. Look to pay your taxes in a quarterly manner so you don't have a big tax bill at the end of the year. Manage your equity compensation and manage your investments to be more tax efficient. Tax planning is not just a thing that you do in March and April every year. It's a year-round process that needs to be accounted for within your financial plan. So, are you tax planning year-round? Because if not, it can cost you.